thank you everyone for coming here today. I would like to welcome you to this event. I promise, I have been asked to say a few words. I promise I'm not going to say very many. As ever, the timing for today's event is very fitting. Only a few weeks ago, we've seen the failure of ABLV Bank in Latvia. Of course, the backstory around the alleged involvement of the bank is a very specific one, but the difficulties of the bank, well, that it found itself in as a result, were run-of-the-mill, a shortage of liquidity after customers withdrew deposits. Now, after the ECB announced the bank was failing or likely to fail, the Single Resolution Board decided that resolution was not necessary as it was not in the public interest and that the bank would be wound down. Let me stress again, in this case, the differences in the circumstances, but last year, 2 Italian lenders also came into financial difficulties. And the ECB then also deemed both Veneto Banca and Banca Popolare di Vicenza failing or likely to fail, and then the decision was taken that the banks would be wound up under Italian insolvency proceedings. This was only weeks after Banca Popular of Spain was failing or likely to fail, which saw a resolution of the group. Banco Santander took over Banca Popular and its subsidiaries without using public funds and following the BRD framework. But when Monte dei Paschi di Siena struggled to get private funding for recapitalization in 2016, the Italian government stepped in with a precautionary recapitalization to avoid the mandatory resolution of the lender. Now you can see where I'm going with this. What does this all mean for future cases of bank resolution within the banking union and the EU itself? Do we have enough clarity what the future approaches might be taken? Now, some experts, including some rating agencies, argue that full clarity over how resolution authorities will respond to bank failures in future depends on the policy framework and the implementation of the TLAC term sheet, clarifications from regulators over individual loss-absorbing capacity targets, and banks actually putting in place the senior non-preferred debt layer. Now, with the EU resolution framework, MREL was introduced for banks in 2014 and is effective since 2016. But with TLAC, yet another acronym made it into the banking vocabulary. Compliance with the TLAC term sheet will be a requirement for all GSIBs from January 2019. Both MREL and TLAC addresses banks' loss absorbency and recapitalization capacity and require a special bail-inable layer of subordinated capital to facilitate a rapid and stable process of resolution. But there are differences between the two, raising questions over the appropriate TLAC implementation into EU law and what changes this might bring for MREL and EU banks. In December, the European Banking Authority published a quantitative analysis of 112 EU banks, which estimated MREL funding needs between 207 billion euros and 285 billion euros. The difference here lies in the 2 different MREL calibration scenarios, the loss absorption buffer scenario and the buffer versus 8% of total liabilities and own funds scenario. Now, several resolution authorities still need to provide clarity over their planned implementation of MREL targets. And also, from a policy perspective, there remain a number of issues to be determined.